Sub-Saharan private equity funds are increasingly setting up shop within South Africa, as with the renewed optimism in the economy, this opens up a suite of opportunities that meet the return profiles of private equity funds. In addition, private equity investors want to be in the countries in which they are invested in. They like South Africa for a number of reasons. It provides an investment-friendly regulatory environment, a sophisticated financial market, a skilled workforce, as well as a robust legal framework. In addition, the South African rand is a lot less volatile than other African currencies, and it is easier to exit investments in our market.
Private equity firms in South Africa are gravitating towards sectors such as fintech, healthcare, and infrastructure. Fintech and healthcare are becoming more attractive given the need for digitization and innovation, which enable value creation. Given the limited capital within the public space, this provides opportunities for private companies to step in and fill the gap.
Catching the eye of private equity investors today are those businesses that are aligning with current market trends. So businesses that are focusing on sustainability, health, wellness, digital transformation, and fintech are appealing to private equity investors. In addition to the obvious strong financial performance and market-leading positioning, private equity investors are also looking at experienced management teams with a growth focus, stable cash flows, revenue that is in hard currency, as well as the ability to build a platform with bolt-on acquisitions. And these are some of the characteristics that private equity investors are looking at.
Private equity firms in South Africa are moving away from traditional strategies and focusing more on reshaping businesses and how businesses can impact the environment and society. This includes implementing scalable models such as creating e-commerce platforms, enhancing governance, and being more proactive in managing portfolio companies to align strategic objectives.
What we're seeing is that investors are looking at risk from a relative basis rather than an absolute basis. South Africa offers institutional depth, regulatory transparency, and is a gateway into the African continent, which compares favorably compared to other high growth but high friction markets. What we're seeing is that investors are not avoiding risk, rather they are pricing it thoughtfully. One of the factors that investors look at when looking to invest in the company is a strong business case. This talks to the value proposition, the market positioning, as well as the competitive edge of that company. What we're also seeing is that it's very important for a company to be able to articulate their growth story. It's not only important to talk to where the company's at, but you also need to talk about the future prospects and the growth and why it matters to investors. In line with that, a company needs to be able to demonstrate consistent and solid financial performance. Regulatory authorities have increased scrutiny within the transaction environment, imposing conditions, therefore leading into uncertainty and longer timelines. Investors, particularly foreign investors, need comfort around the regulatory requirements before they can make any investment decisions. Investors require clear governance framework, which includes robust internal control and transparency, as well as credible leadership.
Post the 2024 elections, a short-term confidence boost was provided to South Africa, signaling political stability. Improved power stability and inflation control also contributed towards the country's attractiveness. Investors are, however, still cautious given the uncertainty around policy implementation and corruption levels. High debt levels within South Africa are also an indicator to the international markets that the country is unable to control its debt levels and increase social spending, which limits their ability to invest locally in infrastructure.
Risk management is evolving, not only to guard institutions against financial shocks, but also enhance long-term business resilience in South Africa's uncertain economic climate. From geopolitical shifts to climate risk, the definition of risk is expanding. Modern COOs are embedding resilience by linking scenario planning, real-time data analytics, and regulatory responsiveness to their core operations.
There's been a notable change in the way companies are performing due diligence. Commercial due diligence has and will always be the key focus of due diligence. But what we are seeing is that sellers are taking a lot longer to prepare their views on selling their business in order to convince buyers that their forecasts are achievable. This is requiring significant prep work as well as constructing arguments to ensure that this is well received by buyers. In addition, what is not a new topic, but a topic that is increasingly gaining momentum is in ESG due diligence. What we are seeing is that ESG is being increasingly woven into the commercial aspects of a transaction.
We are seeing an emphasis on strategic alignment over speed of deal execution. This is driven by a few factors. Increased due diligence is being performed, which helps reduce failure, financial loss, and reputational damage. Decision-making is being more targeted to align strategic objectives with a clear understanding of the anticipated outcomes. There's also being increased efforts made towards gaining buy-in across stakeholders, specifically with regards to incentivizing management to be driven by the investment goals.
The integration of AI into M&A strategies and execution has the ability to revolutionize the corporate finance industry, not only in South Africa, but also globally. As AI can help us automate manual tasks and provide a wealth of knowledge at our fingertips. Specifically in M&A, AI can assist us in analyzing data, streamlining due diligence, assisting with regulatory compliance, as well as provide valuable market insights, amongst others. The increased adoption of AI in M&A has the ability to lead to faster, more informed, and smarter deal making.
It is important for businesses to avoid digital transformation from becoming a surface-level initiative, but rather a strategic lever. To unlock real value, digital transformation must start with business outcomes, not software features. It should be led by strategy and shaped by input from cross-functional teams, not limited to IT or operations teams. Success is not just the cost of saving and adopting new technology. Rather, it is measured by improved speed, quality, investor confidence, and the ability to adapt to scale. In sectors like banking, the COO plays a critical role balancing automation for efficiency and scalability while considering robust data security, compliance, and ensuring clients' trust. As AI-driven decision support and process automation redefine cost and performance dynamics, organizations must remain focused on both the benefits and the risks of digital transformation.
Private capital stepping into traditional public sector roles is evolving in a way that what we're seeing now is that private capital is used in funding basic infrastructure such as your railway networks, hospitals, and schools, amongst other things. We are also witnessing a rise in impact investing and blended financing options that are being used where government budget is falling short. The long-term implications of this shift is that this creates hybrid delivery ecosystems. While this is important, it also raises very important questions about public access, equity, and purchasing power. This shift puts pressure on the government to play more of a regulatory enabler role rather than being the sole operator and funder.
With regards to cross-border M&A opportunities, with the improved macroeconomic landscape, political landscape, and the ability to better price risks, we are seeing an increase in inbound interest from offshore investors looking to deploy capital into our markets. In addition, from a South African perspective, we're seeing companies looking to diversify their earnings into new markets, specifically those that align with them strategically and operationally, where they have relevant expertise and where there is a good cultural fit.
Investor confidence in South Africa will improve with strengthened governance, policy consistency, promotion of public-private partnerships, together with improved infrastructure. Consistent and predictable government policies are essential for long-term effective investment planning. Structural improvement since the elections, especially within the last 12 to 24 months, has provided South Africa with a short-term confidence boost. This provides optimism in the foreseeable future. Businesses with strong and consistent cash flows are becoming more attractive, especially if consumer behavior is limited. There's also being more scrutiny placed on management and executive to align the experience with the objectives of the companies. There's more focus on impact-oriented strategies where investors' financial returns are aligned with more positive and sustainable returns. This also impacts allocation of capital as ESG initiatives are becoming more of an interest in the market. Private equity firms are becoming more deliberate with their investment strategies, where generalist funds are less attractive. With the growing need for internet services and financial digital solutions, the fintech space will be gaining significant traction. However, currently the sectors that are seeing the most activity are infrastructure and renewable energy as the country tries to stabilize its basic utilities. Recent changes within the Pension Fund Act has increased the allocation to private equity funds to 15%, which will also allow for flexibility and increase local investment.